Hello everyone, welcome to Oliveboard. My name is Dinkar and I welcome you all in this session. I hope everybody is doing great, feeling healthy and fine. Good to see you on our Monday's evening 6 p.m. session. As you all know that on Monday, uh, every time we discuss of basics of economy and today also we have a topic on Basel norms. So today we will be discussing about the Basel norms. Okay, so this is one of the most important topic under the economy, and it is related to international financial regulations and everything. So based on that, we are going to discuss our Basel norms today. So first of all, it is a very basic session. Here we are not going into any kind of technicalities because this is basics of economy. So that is why we will be just discussing some of the major portion of that and just try to understand what exactly it is. Okay, guys. So please let me know if you have any question. Just write it on the comment box. I will be keep on seeing there and I will answer your queries. Okay, so let's start with our session right away without wasting our time. And once again, I welcome you all this in the session. And please, guys, those who are in the session, please say hi, hello, so that I can know your name in the chat box, so that I can address you by your names. Because I just really feel happy that if I address the people by their names. So please, if you can say, just show your presence in the session. So I will be much more happier, so that I can know your name. So hello from my side first. So we will be starting with our session right away. So guys, these are the Basel norms. So let's discuss about these. So before going into the Basel norms, because some things will be coming. Okay, so we have Parag. So let me say hello, Parag. Good evening. Welcome to the session. Thank you for letting me know. Welcome to the session. So, guys, before going to the Basel norms, you have to know some definitions. Okay. First definition is capital risk. So, what is capital risk? So, it is a possibility that an entity or a firm or anything will lose money from an investment of capital. So, any company, like a company, maybe your bank or whatever it is, if they have invested their money somewhere, so there is a risk that they may lose their money. So, that is called capital risk. Okay, then capital risk can convert into a market risk, whereas the prices of assets move unfavorably. That means if you have invested at some place, and like if you have invested in the infrastructure sector or your real estate sectors, okay, so if you have invested in all these places, so if all of a sudden the real estate prices get collapsed all of a sudden, so maybe you are not finding that it will collapse, but all of a sudden the real estate market collapse. So this is an unfavorable situation. So that capital risk has converted into the market risk. Or when a business invests in a project that turns out to be a failed business. So there also your money is gone. Then operational risk. It is summarize the uncertainties and hazards of a company faces when it attempts to do its day-to-day transaction. That means whenever, like, if company is working and all of a sudden maybe the fire was there, or you can have an earthquake over there, right? So even in the manufacturing sector, if the automatic, if I don't know, some earthquake or all of a sudden some blast happen or some fire has broken out, so these are all operational risk. Okay, so in day-to-day business activity within a given field or industry. Okay, so these are the operational risks. Then comes our capital. So capital has been broken down into tier 1 capital and tier 2 capital. So there are two type of capitals. Okay, tier 1 capital is also called as core capital. Core capital, like where you have a equity in somewhere places, you have a disclosed reserve that this much money you are having, this much equity you are having, that means this much of shares you are having. Okay, that means core capitals means you have this. Okay, that means if something happens, you have this tier 1 capital. Okay, like if you say that I have a tier 1 capital of 100 crore, that means if anything happens to company or whatever it is, at least this much you are already having. Okay, you do not have to look forward whether I will get this much or no, this is there with you. Okay, then comes our tier 2 capital. So its supplemental capital held as a part of bank required reserve. So tier 2 capital is a little bit smaller than your tier 1, and this is like it supplements the core capital. Okay, so but you cannot say that it may be always available, it may be available, it may not be available, so we don't know. Okay, so tier 1 capital consists mainly of shares capital and disclosed reserve of a bank. These are the highest quality capital because it is fully available to cover any losses that company is going on. Okay, company can sell the things and they can get this much of money. And tier 2 capital on the other hand consists of certain reserve and certain type of subordinated debt. That means you have given some loans and you are expecting that, yeah, once if company is going into the loss, we can recover the money from that place. So it is like a 50-50 situation, whether you can recover it or whether you cannot recover it. Okay, but tier 1 is called as the highest quality capital. Okay, then capital adequacy ratio. A bank with high capital adequacy ratio is considered to be above the minimum requirement needed to suggest the solvency. That means every bank has to maintain a certain amount of capital adequacy ratio. Okay, so the higher capital adequacy ratio, higher it is, more it is to be able to withstand any kind of financial downturn or losses. That means more and more higher ratio you are having, more you are safer. Okay, the more capital adequacy ratio you have, the more safer you are. Okay, so capital adequacy ratio is a measure of how much capital bank has available, reported as a percentage of bank risk weightage credit risk. Okay, so bank is having some certain amount of money and certain amount of money bank has given as a credit. Okay, so it is a ratio of that capital that bank is having and to the ratio of the risk weighted credit exposure. Okay, so the purpose of this is to establish that bank have enough capital. Why we wanted this capital adequacy ratio to be higher? Because we wanted to make sure that bank should have enough capital on reserve to handle any losses that are coming on their way before it became insolvent. Okay, that means it will act as a cushion to bank. That means if some losses or some NPA has happened, so still bank has that much of capital that they can withstand the losses. Bank can withstand the losses. Okay, so higher the capital adequacy ratio, higher will be the bank recovery. Okay, so here now we start with our Basel Accord. So now we have gone into the definition. Now we are actually moving into the topic. So Basel Accord. So international banking regulation issued by the Basel Committee of Bank Supervision. It is called BCBS. Okay. So these are international banking regulation that in all the countries, what regulation that bank has to maintain. Okay. Goal of strengthening international banking system. It sets up the agreement by the Basel Committee of the Banking Supervision which focus on the risk to the bank and the financial system. So the main focus of this Basel Accord is that we have to make sure that our bank remains in a healthy position. So that is why some agreement and some kind of directions has been given by this committee. That is Basel Committee on Banking Supervision. See, this Basel is a place in Switzerland, so that is why these accords have been taken over from there only. So that is why the name has been given as Basel Accords. Okay, so what are Basel Accord? The Basel Accord are a series of 3 sequential banking regulation agreement: Basel 1, Basel 2, and Basel 3. Okay, so they have been set up by Basel Committee on Banks and Supervision, BCBS. Okay, so after a few years, one new regulation comes that now a bank have to perform this, now bank have to reach to this level, now bank have to reach to that level. So till now 3 Basel Accord has happened and all the countries are trying to maintain all the 3 accords. Okay, so the committee provides recommendations on banking and financial regulation specifically related to capital risk, like when you are giving loans or something like that, and market risk. All of a sudden there is sudden change in the market, and operational risk. Okay, so the accord ensure that financial institutions have enough capital on account to absorb any kind of unexpected loss. So if any kind of unexpected loss is happening, so bank should have enough capital in order to absorb that loss. It should not be like that all of a sudden if some kind of market risk has happened and bank has gone into totally non-performing way. Okay, bank has shown too much of losses and all of a sudden the bank has shut down. No, we do not want that. Okay, so that is why this Basel Accord and Basel Committee guide the banks for operational risk, capital risk, market risk, so that they should have enough capital in their accounts to absorb any kind of unexpected loss. Okay, so the Basel Accord were developed over several years. It started beginning in 1980s. So BCBS was founded in 1974. It is a forum for regular cooperation between its member countries on banking supervisory matters. Okay. Now, BCBS describes its original aim as the enhancement of financial stability by improving supervisory know-how, like how you are going to maintain the financial stability, like supervisory know-how, quality of banking supervision worldwide. Later, the BCBS has turned its attention to monitoring and ensuring the capital adequacy of the banking. So right now, the Basel Committee and BCBS is mainly looking for the capital adequacy, whether banks are having proper capital or not to absorb any kind of loss. Okay. So the meetings are named as Basel Accord since BCBS is headquartered in the office of Bank of International Settlement BIS that is located in Basel in Switzerland. So member countries are Australia, Argentina, Belgium, Canada, Brazil, China, France, Hong Kong, Italy, Germany, Indonesia, India, Korea, US, UK, Luxembourg, Japan, Mexico, Russia, Saudi Arabia, Switzerland, Sweden, Netherlands, Singapore, South Africa, Turkey, Spain, and many other countries, those who are the part of this Basel Committee. Okay. Now, Basel 1. First meeting. So the first Basel Accord, that is known as Basel 1, was issued in 1988 and they are focused on capital adequacy of the financial institution. Okay, capital adequacy risk, that is the unexpected loss, would hurt the financial institution. So what they have categorized, that they have categorized the assets into 5 risk category. That means 0%, 10%, 20%, 50%, 100%. So there are some kind of asset on which you have a 0% risk. That means there is no risk. Some type of assets are there where you have given loan but they are carrying a 10% of risk. Okay. Then some assets are there which carry 20% of risk. Some assets are there who have a 50% of risk. That means they may give all your amount or they may not give. And there is somewhere is a risk of 100%, like personal loans. Like there is a situation of total default can happen. Okay. So under Basel 1, bank that operate internationally must maintain capital tier 1 and tier 2 equal to at least 8% of their risk weighted asset, RWA. Okay. RWA. That means any bank who is working internationally, they have to maintain at least tier 1 and tier 2 capital of 8% of their risk weighted asset. Okay. So because this ensure bank holds a certain amount of capital to meet the obligation that are you will get. Okay. So let's understand with this an example, right? So for example, if a bank has a risk weighted asset, RWA, of $100 million, so at least 8%, that means $8 million bank has to keep capital in their accounts. Okay. So tier 1 capital is the most liquid and the primary funding source of the bank, and tier 2 includes less liquid hybrid capital instrument, loan losses and revaluation reserve, as well as undisclosed reserve. Okay. So it is like that. if you have a risk weighted assets of $100 million, that means up to 100 millions loan you have provided. So in the back, you should have at least $8 million as a tier 1 plus tier 2 capital with you. So that if any situation happens, any type of risk, your capital risk, market risk or operational risk happens, so you are able to easily absorb that kind of loss. Okay, so that has happened in the Basel 1. Now come our Basel 2. So the second Basel Accord, called as revised capital framework. So it is just a revision on that Basel 1. So it is better known as Basel 2. Serve as an serve as an unupdated of the original accord. So it focused on three main area. First is minimum capital requirement you have to maintain. Then second one is supervisory review of an institutional capital adequacy. So some supervisory review can also happen. And internal assessment and market discipline. Internal assessment process and an effective use of disclosure as a level to strengthen the market discipline. This is the third one. And encourage sound banking practices, including supervisory review. So here they have ensured that minimum capital, that means that is the Basel 1, you are also containing here. Plus here two more things are added, that is supervisory review and market discipline. Whether you are following proper supervisory review, like if somebody wanted to supervise your things, whether you are performing the things in a proper way or not and everything. So that has to be there. Okay. So together these area focuses on that is called three pillars of Basel 3. Okay. Pillars of Basel 3. Basel 2. 3 pillars of Basel 2 Accord. Okay. So it focuses on minimum capital requirement, supervisory review of institutional capital adequacy, internal assessment, and third one, to strengthen in market discipline and encourage sound banking practices, including supervisory review. Okay, so these are the 3 pillars. Now, so this is what Basel 2 is all about. Minimum capital requirement describes the calculation for regulatory capital for credit, operational and market risk. So pillar number 2, supervisory review, bridge the gap between the regulatory and economic capital requirement. It gives supervisor discretion to increase regular capital requirement. Though, like if some supervision is happening and it is found that at least bank should have 20% of the capital, risk weighted asset capital. In the Basel 1 it was 8%, but if during the supervisory review the officer says that at least that bank has to maintain 20% because there is a huge risk that is involved with this bank. Okay, so supervisory review can be a part of that. Then market discipline. So it allows market discipline to operate by requiring lenders to publicly provide the risk management activities, risk rating and risk distribution. With this, proper market discipline can happen. Okay. Now, the new tier 3 capital, that is also called as tertiary capital, which many banks hold to support their market risk, commodity risk and foreign currency risk derived from the trading activities. Tier 3 capital includes greater variety of depth than tier 1 and tier 2. Okay, but the quality of this tier 3 capital is lower than the two of them. So, but under the Basel 3 Accord, this tier 3 capital was removed. Okay, so right now only two tier are there, tier 1 and tier 2 capital. So in that Basel 2, they have tried to include a tier 3 type of capital also, but because of some kind of issues and low quality of this capital, that has been removed in the Basel 3 norms. Okay, so anybody has any doubts till now, guys? Please let me know in the chat box. Anybody has any kind of doubts? Now comes our Basel 3. Okay, so this Basel 3 comes because of the collapse of the Lehman Brothers in 2008, and it was a financial crisis of our 21st century that has happened. Okay, and the BCBS decided to update and strengthen the stock. So now BCBS, Basel Committee on Strengthening of the Records, has updated the strengthen and the accord. That means they try, like they thought that Basel 1 and Basel 2 are not able to get the work that has to be done. So that is why they wanted to include all the things in the Basel 3. They wanted to update and strengthen more the Basel 3 Accords. Okay, they wanted to strengthen more in the Basel 3 Accords because of the collapse of the Lehman Brothers. That means people are not following the things in a proper way. Okay, so the BCBS considered poor governance and risk management, in inappropriate incentive structure, and an over leveraged banking structure as a reason. So before putting the Basel 3, they have said that there are few issues that has led to the collapse of the international financial system, especially the Lehman Brothers. That means poor governance. There was a huge issue with the governance. There is a huge risk management. They are not able to take care of it. Unnecessary incentives people are getting in these companies. Okay, and over leveraged banking industry. That means, okay, you do whatever you want, you just show the profit. Okay, and so in November 2010 an agreement was reached regarding the overall design of a capital and liquidity reform package. So this agreement was known as Basel 3. Okay, now Basel 3 is a continuation of the three pillars what was happened in the Basel 2, with additional requirement and safeguard. So here some additional requirement and safeguard has been put on. Okay, like Basel 3 requires bank to have a minimum amount of common equity and minimum liquidity ratio. So Basel 3 also include additional requirement for what the accord called systematically important banks. So here the example come systematically important bank. I hope everybody has heard of the word. So here Tejas, you will get your example. Okay, here Tejas, you will get your example. India government has decided to give the accord to domestically systematically important bank. ICICI Bank, HDFC Bank, SBI Bank. That means these banks are too big to fail. That means if the banking system of these banks is failed, that means the whole economy is going to suffer. Okay, so if any issue is happening with these banks, government has to come and has to support these banks and bring out these banks out of crisis. Okay, so this is the main thing that has been added. Domestically systematically important bank, that is, these are the most important banks which you cannot allow to fail. Okay, so in America it is Citibank. Okay, so in doing so it got rid of tier 3 capital consideration. So we do not need tier 3 consideration and like that. Now, so the Basel 3 reforms have now been integrated into the consolidated Basel framework, which comprises all the current and the forthcoming standards of the Basel Committee. So Basel 3 Tier 1 now has been implemented and all. But one of the 27 committee member countries participated in the Basel 3 monitoring exercise held in 2021. So the final Basel 3 framework includes phases in provision for the output floor, which start with at 50% on January 1, 2023, rising in annual steps of the 5% and will be fully phased out at the 72.5% level in January 2028. So these 2023 onward measures have been referred to as Basel 3.1 or Basel 4 measures. So slowly we are trying to strengthen our position in the Basel Accords. Okay, so now we will be doing just a revision on what has happened. So in the Basel 1, what has happened? 5 categories of the credit risk were there. 0% category, like comprises of central bank, cash, government debt and home country debt. All these are there. That means they are having very low risk or zero risk. Then comes our 10% category risk, public sector debt. There is a 10% risk is associated with that. Okay. Then comes our 20% risk category. Okay. securitization such as mortgage and backed securities. Then comes our 50%, that means residential mortgage, municipal and revenue bonds are there. So there is a 50% chance of defaulting on that, and there is 100% things which are at the risk. That means they have a risk of 100%. That means they, if they fail, so there are, like if you have invested 10 lakh rupees, so there is a chance that your whole 10 lakh rupees can go. Okay, so there is 100% risk. So that includes like corporate debts. Most of the things, like in our India, Kingfisher has taken, Punjab National Bank has given to Nirav Modi, then our real estate sector. Okay, all these sectors are there. Okay, then Basel 2. Basel 2 has asked for minimum capital requirement that banks should hold. Okay, then supervisory review, that means you should have a supervisory review that decide like how much minimum capital requirement you should know. Like if they have given that okay 8% is the minimum that you have to hold, but during the supervisory review they find that this bank has given loan to the people who are not that much credit worthy, so the under the supervisory review they have said that you should at least maintain 50% of the capital adequacy, 15% of the capital adequacy ratio, 15% of the tier 1 plus tier 2 capital. Then at the same time you have to follow the proper market discipline, proper regulatory framework and everything. Okay, then our Basel 3, under that also 3 pillars were there. Minimum capital and liquidity requirement should be there, that means the money should be present in a proper liquid form. Then pillar number 2, again supervisory review, process firm wide risk management and capital planning. And pillar 3, again market discipline and all these things. So the main thing is only is that in every Basel 1, Basel 2, Basel 3 accord, they just wanted to increase the quality of the tier 1 and tier 2 capital. Okay, they wanted to increase the quality of the tier 1 and tier 2 capital, and they also want to make sure that the proper risk weightage asset, that means the more the credit where you have given, you should make sure that minimum default should happen in that. Okay, you should maintain that minimum risk should be there in that. So here if you see that under Basel 1, make sure that you have a more of 0% category of loan that you have given, or if you wanted to give, you can move on to the 10% category you can give, but try to avoid the sector where there is a 100% issue with the risk weightage. Okay, so this is the difference between like Basel 1, Basel 2 and Basel 3. Mainly it is just requiring your proper capital requirement in the bank. At the same time we wanted to increase the risk weighted asset ratio, so that we should provide the loan to only those sector from which we can easily recover. So 0% risk, 10% risk, 20% risk, or at the last you can have a 50% risk category also. But try to make sure that if you are giving the loan to 100% risk category clients, so you should have a proper mortgages and proper type of links and everything with them, so that you should not lose much of your money. Okay, then so this is how all is happened. Basel 1 happened in 1988. 5 risk, 0%, 10, 20, 50, 100. So capital adequacy, capital requirement of the at least 8% of the risk weighted asset. Then in the Basel 2, they have introduced standardization and internal rating. They have increased, they have tried for an internal rating and for foundation of internal rating business. And then in the Basel 3, introduction of loan to value based on risk weight. Okay, revised exposure of unrated loans, like you have to check that if you are providing loan to rated companies or unrated companies. And here there is a removal of IRP, internal rating based approach. Okay, then in Basel 4 we are looking for loan to value based approach for most retail asset, standardized credit risk calculation and removal if IRB approach for most asset classes. Okay, so this is the like what has happened, and then what has been removed and what has been added. Okay, so guys, this is all for today, and if I hope I have already told you all the differences that is there in the tier 1, tier 2 and tier 3 capital, and various type of Satyendra, you are asking regarding tier 1 and tier 2 capital. So, for you, let me tell you that I have already told in the starting that regarding the tier 1, see here, tier 1 is called as core capital. Core capital means that type of capital is there with the bank. Like if bank is failed, is still this bank will having that much of money like 100 crores, 200 crore, whatever it is. So bank is having, that means bank is sure of this money. That is called core capital that bank is having. Tier 2 is a kind of a capital where bank is sure that they will get it, but how much they are going to get it, they are little bit unsure about that. Okay, so tier 1 capital is a highest quality capital that bank is having, and tier 2 is a supplemental capital. Okay, here bank has not told that we have invested here also, we have invested there also. So these are tier 2, tier 2. Tier 2 are a kind of undisclosed thing, and tier 1 is or disclosed. Everybody knows what bank is having, but in tier 2 it is undisclosed. Okay, anybody else has anything to ask? Okay, thank you so much, guys, for listening to me, and it's really great to see you on the Mondays evening. So I will be meeting you again on the next week at the same time, 6 p.m. With one new topic, and I hope you have understood the Basel Accords and all the things are there. If you have any question after that also, please just leave a comment on the comment section after the session gets over. I will see your comments and I will surely answer over there. Okay, guys. Thank you so much, Tejas, Satyendra, Parag, and thank you for joining the session and all the people who were there in the background. Thank you so much for joining the session. Please do not forget to like, subscribe, and follow. Happy learning, guys. Thank you so much. Bye bye. Take care. And please follow all the COVID-19 protocols properly because, as you all know, that cases are rising. So I need all my aspirants and students to be remain safe throughout this time. Thank you so much. Bye bye and take care.